Just heard that Shinzo Abe assassinated today, period. Killed while giving a speech, period. Looks like a real breakdown in security, period. Hi, John.
Hi.
You've come back for more, huh?
Apparently I am.
More punishment, huh? Okay. All right. Well, hopefully it won't be as grueling as that. We spent a good hour, it looks like, huh, on the prior class. So let me
Yes,
just
we
check.
did.
That is John. How you doing?
Good. So
Okay. All right. Are you from around here, John? Did I ask you that? I'm always
yeah,
curious.
I live up in San Ynez Valley.
Okay. I used to live near the Jersey Shore.
Uh,
Come on, share screen. Okay, well, this should be easy stuff for you after what we did in 2:30, but we'll get this going for the rest of the class. Okay, John, me and you.
sounds good.
Okay. Well, the accounting equation. Business entity, any individual organization that gets together formally to try and make money. And since we're dealing with very small businesses in this particular class, you have an owner who might be drawing his own assets out of the company all the time. And they need to be kept separate from the normal accounting cycle. The business entity concept, this is one of the first GAAP principles. It means that it is a measurable and ongoing type of situation. And it means that you got to separate the business part of it from the owner's personal spending. Assets. Anything of value owned by the company, huh? Cash, merchandise, or inventory, which is the same thing, furniture. Accounts receivable, and you'll be learning about each one of these guys. Accounts receivable, that's the amount of money owed to you at a point in time by all of your customers. You might have 1,000 customers, and each of those customers owes you an average of $1,000. That multiplies out to $1 million. So your accounts receivable is $1 million. That guy owes us 1,000. That guy owes us whatever, okay? That's called a sale on account. When you see the terms on account, I'd like you to say to yourself, on account and nobody had money. There's no cash involved in the transaction, okay? So we sold something, but not for cash. We're going to get paid later. We're going to increase accounts receivable and increase our revenue. Liability, that's an IOU, that's a debt, that's a chit. That's a promise to pay. Something owed to another business entity. And accounts payable and notes payable are two you're going to see quite a lot. Accounts payable is the reciprocal of accounts receivable. Accounts payable referred to making a purchase on account. Again, on account and nobody had money. Be careful. Don't confuse accounts receivable and accounts payable, which is easy to do. Ask yourself, are we waiting to receive money or do we have to pay the guy? Okay. Accounts receivable, we're receiving money. Accounts payable, we're paying money. We owe money to somebody. Okay. Keep those two straight and that'll be a big help early in the class. Notes payable, this is just a borrowing situation. Notes payable is not the same as accounts payable. Accounts payable represents all of the suppliers you owe, all of your normal providers, the people who sell you your merchandise, the electric company, the insurance salesman, things like that. Notes payable means you borrowed money and need to pay it back with interest. Notes payable is a very formal, handwritten document with interest rates, specific times, and rules for payment. Owner's equity, huh? Assets equal liabilities plus equity, right? Assets equals liabilities plus equity. Also call it the net worth, the capital. It has nothing to do with what the business might actually be worth in the real world, okay? It's just the way the transactions have taken you. You have a business with $1 million in assets. Would you pay me $1 million for that company? Probably not. Would you pay me $500,000? Your answer should be no, not until I know how many liabilities you have. If you have $700,000 in liabilities, the net worth of your company is only $300,000. That's the negotiating point to get started. The accounting equation, assets equals liabilities plus equity. The left side shows the assets and the right side shows where the money came from, liabilities and owner's equity. If a business had total assets of 60,400, total liabilities of 5,400, what is the equity? Well, that's pretty easy. 60,400 assets equals liabilities plus equity. Let's see. 6,400 minus 5,400, 55,000. And remember, the accounting equation must always remain in balance. And I doubt you'd ever have a problem with that in the year 2022 forward. Okay, we did this in accounting 230, John, and the rest of the class. We're going to go through some basic business transactions working with the accounting equation, okay? Each account represents a separate folder that's called the general ledger. You have a general ledger, and each piece of that ledger you can think of as a folder. Cash would have its own folder, accounts receivable, electricity. So they're talking about analyzing business transactions. Look at this slide and let this kind of sink in a little bit, okay? 3 questions. What happened? Make sure you understand the event that has taken place. Well, it could be something as simple as you opened up your mail and right in front of you is the electric bill. Well, what has taken place? We got the electric bill. That's what's taken place. So now we have to record that electric bill. So what accounts are affected? You know you're going to have at least 2. Every transaction in accounting has at least 2 pieces. Eventually, you'll learn that there's at least 1 debit, 1 credit. Identify the accounts and figure out what's an asset, liability, or equity, and determine which have increased or decreased. So let's look at some transactions here. Mitchell's Delivery. This guy delivers pizzas around college campuses. He invested $5,000 from his personal bank account and deposited it into a company called Mitchell Williams Deliveries or something. So the accounts that are affected, let's see, cash and equity would have to go up, right? Cash, and now he has a business that's worth $5,000. Capital goes up, capital or equity. In 230, you call it stockholders' equity. So let's see, cash is an asset, that goes up, and owner's equity, that's capital, that goes up. Is that going to keep our equation in balance? The answer is yeah. Yes. Cash, 5,000, total assets equals liabilities plus equity. We're in balance. He bought equipment for cash. That's what happened. Well, we spent cash, so we know something's going to happen to cash, and he bought delivery equipment. They're both assets. One asset's going up and one is going down. Cash is going down and delivery equipment is going up. So let's take a look at our accounting equation. Cash goes down 2,000, gives you 3,000, and the other asset went up 2,000, your delivery equipment. So you're still in balance. Now we bought something on account. On account of nobody had money. It means that we're going to pay this later. On account. When you see on account, it's 99% of the time either accounts receivable or accounts payable. Since we are buying the equipment and must make a future payment, this is clearly accounts payable. And we're going to make the payments over 3 months, apparently. So what accounts are affected? Equipment, that's an asset. We added another piece of equipment, but now we have our first liability, accounts payable. So we're going to increase delivery equipment and increase accounts payable. Take a peek. Delivery equipment went up by 1,800, but so did accounts payable. And we're still in balance. 6,800 equals 60 equals 1,800 plus 5,000. We paid part of that loan now. We paid $600. So let's see, that affects cash, right? When you see the word paid, substitute cash for it. We paid cash. So cash is affected. Accounts payable is affected. Let's see, that's an asset and a liability. That's an asset and it's a liability. I said that's an asset and a liability. Now I look like an idiot. Come on. And here, let's take a peek at it. Cash went down $600. So now we only have $2,400 left in cash, but our debt went down by $600. We made a payment. Now we only owe $1,200. Revenues are sales. Revenues are recognized at the point of the service being rendered or the product being delivered. Okay. It has no relationship to when the cash changes hands. Quite often it happens at the same time, but that's not the driving force. We record revenues as soon as we've shipped the product or performed the service. We don't care if we've been paid or not. We record the revenue now, and we record expenses now. And this guy has delivery fees, Mitchell, but there's all kinds of different kinds of revenues, sales, delivery, consulting fees, whatever. Same thing with expenses. We record the expense when it's incurred. At the end of the month, well, we know we had salaries for people who worked the last couple of days of the month. They're not going to get paid for that until next month. We have to record that now in this month's expenses. Here's an accounting concept called periodicity. Periodicity. I love that word. It just means that you can take, the theory is you can take any business and break it down into its period, typically a month, a quarter, a year, whatever. And any accounting period is called a fiscal year. An accounting period of 12 months is called a fiscal year, and it can be different than a calendar year, and often is. I don't think you need to come to college to understand this one, huh? If your revenues are higher than your expenses, you made money, you have net income. If your revenues are exceeded by your expenses, you lost money, okay? And that happens in the real world all the time. Withdrawals. Now, this is something you're not going to see when you get to 230. Withdrawals, also called drawing. What this is, the owner comes out to you in the accounting department and says, hey, Walter, I need $1,000. Cut me a check right now. And you say to him, yeah, boss, no problem. What's it for? And the boss says, I'm going to Las Vegas for the weekend. As soon as you hear that, you know it's a personal debt of the boss, personal business of the boss, rather. That's called a withdrawal. And here's how the withdrawals work. You are going to, oh, I take the wind out of my sails there, John. They don't go into the withdrawing entry after they built it up. But let's say the guy drew out $1,000. you would see 1,000 here for drawing as a plus and 1,000 coming out of cash over there. Delivery
So-
revenues earned in cash. This is easy. He delivered $2,100 worth of pizza. That's revenue. That's a sale. Cash goes up 2,100. So does the sale, the revenue. Okay. Paid the rent. That's an expense, right? We know what happened. We paid the rent. Well, that means rent expense. As soon as you see the word paid, you know it's cash. So the cash is going to go down 1,000, but the expense is going to go up 1,000. And notice we're still in balance, huh? We're still in balance. Phone bill, that's another expense with the same thought process. Paid it in cash, minus 100, plus 100 expense, okay? So by doing these transactions, this should start making a little more sense. And when we get to chapter 3, you'll be in a little better position to battle the world of debits and credits, okay? Now, delivery revenues earned on account. Mitch went out and he sold $2,400 worth of pizzas to the faculty party here at City College. And the deal is we're going to pay him later. So Mitch delivered, you know, maybe whatever this comes to 100 pizzas or something, and he delivered them all around the school. We owe him 2,400. And remember, when you see the word on account, the words on account, it's going to be accounts receivable or accounts payable. This time we're selling the product and expect to get paid. So it's going to be accounts receivable that's going to go up and our fees are going to go up. We added a new asset here, accounts receivable, and there we go with the fees. We have our second sale. The first sale was for cash. The next one was on credit. We bought supplies for $80. Until we actually use the supplies, we're going to call them an asset. And that asset is called prepaid supplies. And they're telling you right here they paid cash. So you know cash goes down $80. And now cash has gone from 3,400, 3,320, and supplies have gone up. It's another exchange of assets is what we did there. Now, we're getting paid in cash for a sale we made earlier. Remember we sold $2,400 on account? Well, now we're getting paid. So let's see here. We received $1,900. Equity's not affected because we affected equity when we recorded the revenue. On here, all we're doing is we're going to increase cash by $1,900 and reduce accounts receivable. That's all we're going to do there. Well, this thing's giving me a tough time. So let's take a careful look at this. We got paid. We got cash, went up, but the offsetting asset went down, accounts receivable. So now our customers only owe us $500 because we collected the $1,900. Notice that the payment we received had nothing to do with revenues or expenses. We recorded them when we made the sale last month or earlier in the month, I guess. Oh, look what we have here. Purchase of an asset on account, making a partial payment. So let's take a deep breath. Purchase of an asset on account. Well, purchase means we're going to be paying for it later. So we know that accounts payable is going to be impacted. But with this transaction, we also made a partial payment. So we bought a scooter for $1,000. So delivery equipment's going to go up. We paid $3,000 in cash, right? So we know cash is going to go down. And the difference we owe in terms of accounts payable. So cash decreased by $300. That makes sense. We bought a machine for $1,000 and we owe $700. Owner's equity is unchanged because it has nothing to do with the income statement. Here we go. The accounting equation. We purchased a machine for $1,000. We paid 300 down. That brought our cash down from 5220 to 4920. We have a machine we added, but now we have an additional debt to pay, $700. So that was a three-part entry there, three-line entry. Paid insurance premium. Okay, let's talk about this. We bought an insurance policy that lasts 7 months, huh? By definition, when you purchase an insurance policy, it is not an expense. It's considered an asset because you don't get the benefit of the insurance policy until the policy actually kicks in. In other words, you bought this policy at the end of December, and now you're putting it in as an asset. It's going to be expensed out over the next 7 months. So let's see what we're talking about here. We bought an insurance policy. Well, that's an asset called prepaid insurance. And it looks like we paid cash for it, huh? We paid cash for it. And here we see it. Cash went down, the asset went up, prepaid insurance. Eventually, that prepaid insurance is going to be turned into an expense in the future. Okay, you're all working people. This is right up your alley. Mitch paid $1,650 in wages to his employees. That's an expense, obviously, right? Wages expense. You not debit, but you increase wages expense and you decrease cash. Take a peek at it. Here's an expense, $1,650, cash minus $1,650, okay? Here we go. Now we made deliveries for cash and on account. So is it on account, accounts receivable, or accounts payable? Deliveries made. We made deliveries for cash and on account. So part of this is going to be accounts receivable. We delivered $3,500 worth of pizzas. $900 we collected cash, right away. $2,600 we're going to receive later. So what's impacted? Cash goes up for $900. The receivable is going to go up by $2,600, and the total sale was $3,500. Total sale was $3,500. Let's take a peek. Our revenue went up $3,500. Hooray, we're up to $8,000 in total revenues for this business. We paid $900 in cash, and the rest of it is going to be in our accounts receivable, the $2,600. You see, John, I got confused for a second there. I thought we were looking at accounts payable for a split second. Easy mistake to make. And finally, I think it's the last transaction anyway, withdrawal. And you don't have this in 230, just here. Mitch took $3,000 out of the business for personal expenses. Well, what happens when the owner withdraws money is that the net worth of the business goes down. It's not an expense. This is not an expense, okay? Whoops, excuse me.
Yeah, this seems similar to when a company provides dividends in that you're taking money out of the business and giving it back to the owner.
There you go. I never thought of it that way, but yeah, that's a good point. You think of it this way, the withdrawal is the owner making you take something out, and the dividends is a decision of the company itself. Yep, same exact thing. And in both cases, you're going to debit equity and credit the cash. So we're calling this equity piece withdrawals. So the guy took 3,000 out, drawing one up. You notice that reduced the owner's equity. He had 5 minus the 3, he's down to 2 in equity. but then he's going to pick up 10 now in sales minus the expenses. Let's look at the financial statements here. The financial statements. You're going to always have to do an income statement, equity statement, and balance sheet. And they're done in that order. There's no chance to do them in any other order. You got to do the income statement first because we have to get the net income for transfer to the statement of owner's equity. And when we get the new owner's equity, we have a number now to transfer to the balance sheet. So you have to do them in this order. And on the test, we love to ask, what order do you do the financial statements? And then the headings, company name, income statement for the month ended. And I'm not going to go into this. They're talking about using single rules as opposed to double underlines. Everybody has their own style. Every company might do them a little bit differently. So the double underline indicates a total. That's pretty universal. Look at our income statement. Look at the income statement, $8,000. And the expenses were wages, rent, phone. Where did we get those numbers? Where did we get them? We got them right from here. Here's your 8,000 in revenue, and here's your 2,750 in expenses, which, as I recall, were wages, rent, and phone. So this guy made a profit of net income, 5,250. That's a pretty darn good return. That's almost 65%, right? So he made 5,250. We do the income statement first because we're going to take that number, that blue number, green number, whatever color that is, that 5,250, and we're going to bring it over to the equity statement. The equity statement in 230, we call it the statement of retained earnings. So what do we have here? We have a beginning balance of 5,000. I'm calling that initial, that's beginning. Beginning plus net income minus withdrawals gives you the new equity. Bide your time, BIDE. Beginning equity balance, beginning capital balance, add net income, less drawings, withdrawals or drawings equals ending inventory. You may like those mnemonics. So now that we have the 5,250, we're in position to do the balance sheet. The balance sheet. I said we're ready to do the balance sheet. Here we go. Here's your simple balance sheet. The balance sheet reports the firm's assets, liabilities, equity on a specific date. You notice what it says here? June 30th, 2020, right? If you looked at the retained earnings statement, it said June 30th for the month ended, and same thing here for the income statement. You can't say for the month ended with a balance sheet because it's a snapshot in time. This is exactly how much cash you had in the bank at that time. That's exactly how much money your customers owed you, 3,100, etc. So take a look at the balance sheet. It's just a replication of the accounting equation. Assets, in this case, total 9,150. You have 1,900 in accounts payable, 7,250 in capital, adding up to 9,150. Okay. And yeah, the underlines they're showing there are good. The only thing I don't like, I'm assuming this would be in Excel. I like to see the line cover the entire cell, not just in the middle like that. But that's just me, okay? The three basic phases of the accounting process. I have no idea what the heck this is. This kind of makes me chuckle. Accounting process, three basic phases. Input, business transactions provide the necessary input. Processing, recognizing the effect on the assets, and output. The only reason I mention this is that somehow, some way, this question popped up on one of the tests recently. So if you can remember IPO, input, processing, output, the question was in the form of multiple choice. What is the what are the sequence of the accounting process? This is it, IPO. And that brings us to the end of the class. Okay. What do you think, John? Any questions here?
No, I think it's pretty straightforward.
I think you can see why it would be wise. I mean, you're doing very well. I know you're going to do great with this, but I think you can see, having gone through a little of this, why 110 is a pretty good preparation for 230.
Yeah, I can see that basically these first few classes are giving you that summary overview that you use in 230. And then it
Yeah,
looks like it also covers things like um, QuickBooks or stuff like, just an overview of how everything ties together.
yeah, yeah. And the two courses uh, travel in different directions when we get done with chapter 6.
Okay.
So you guys have a test on chapters 1 through 4, do you?
Yeah, we have that test between now and Saturday night.
Okay. Hey, good luck with it. You can always text me if you have an emergency question or anything.
All right. I feel pretty good. Thank you.
Hey, John, you take care. Have a good weekend.
All
Bye-bye.
right. Bye-bye.
Yeah. This is my Yeah. Many's the time I've been hurt. Many all of my money, but that was when I was much younger. Made up my mind to be careful.